The key issue, though, is this. Glass-Steagall should not be seen. It's a very legitimate policy debate to have, but it is not a substitute for other regulation, and that's what troubles me. Glass-Steagall would not have stopped the making of bad mortgages, of subprime mortgages. Banks had the right to make those mortgages with Glass-Steagall. There were no standards that said you can't lend money to people who can't pay you back. Secondly, the whole derivative, unregulated derivative trading, again, that would have been perfectly legal under Glass-Steagall. And just remember, let me close this opening thing with this. Lehman Brothers fails, and then AIG needs to be bailed out. Neither one of those would have been affected by Glass-Steagall. So, yes, it's a good debate to have, but the notion that it's a substitute for regulating bad subprime mortgages, putting derivative trading in a more market-oriented focus, that would be a grave mistake.
Barney, I think people are coming at this from two different sides. There's one side that's talking about this from a regulatory perspective. I think the Trump administration, to some degree, is talking about this from a growth perspective, which is to say that if you could effectively divide these firms and unleash the investment banking side, which has been ultimately corralled by the regulation, that maybe you would grow the economy. Do you buy that argument?
No. First of all, it's interesting. Today's Wall Street Journal, which I was reading as I was waiting to come on, talks about how Goldman Sachs has now gone big into the lending business.
Yes.
And so it would cut off that source of loans. You would tell Goldman Sachs, no, get out of the lending business. But secondly, the implicit in your question is that you would separate investment banking from retail banking and not regulate. And here's the flaw in that. It is true that the initial impulse to regulate banks was that they got deposit insurance, and you wanted to protect deposit insurance fund. But in 2008, we had a crisis triggered by AIG that didn't affect the deposit insurance fund. You had an insurance company that started selling an obscure, until then, form of derivatives called credit default swaps. There were $170 billion in debt beyond what they could pay off. That's why the Bush administration stepped in and bailed them out and said, well, we're going to have to pay those debts at the Fed. The problem is, if you simply impose Glass-Steagall and then remove the regulations, as the question suggests, and I don't mean you, but that's the rationale for it, nothing stops the then investment banks like AIG from incurring debt in derivatives that they can't pay off. One of the most important things we did in the bill was to say, not that you can't do these derivative tradings, we don't ban it, we said do it in the market, put them on exchanges where possible. Right. Make sure that you have the margin and capital to back them up. So allowing investment banks to go into an unregulated sort of set of rules the way they had before is very risky.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.